This next section is a fun part. We are going to come to what we think is our target price for the company, or another way of saying it is, what do we think the intrinsic value of this company is? And then we'll compare that to the current stock price, and we'll find out whether we think this is a great investment idea. So there's two ways that we can come to for calculating the intrinsic value of a stock price. And the first one is the relative valuation method. And here our go-to method is the PE ratio. And so this is perhaps one of the most common questions that I receive from YIS members is James, I'm not quite understanding how to use a PE ratio or a price to book ratio and calculate a target price. It's fairly straightforward, and it starts with creating the forecast of a company. And so what are the current earnings per share? What do I think those earnings per share will be next year and in 3 years? And then in 3 years, let's say, we come to an earnings per share of $1. And the stock price is at $20. So 20 divided by 1 means it is at $20 would be the PE ratio of the company. So what do we do with that PE ratio? And what is a high PE ratio? What is a low PE ratio? So what we're going to do is we're going to say, I think this business deserves a 20 times PE ratio, and then we use that number based on our forecasted earnings per share. So let's use an example. Let's say we have Chipotle, and Chipotle is a restaurant business and it sells burritos, and we think this is a good investment. And the current earnings per share is $1 per share, and then we forecast that forward 3 years, and we think in 3 years it's going to be $1.30 earnings per share for Chipotle. Okay, so we have one of the key components. So what then do we do with what multiple we put on that? Well, what we would do is we would say, okay, in the past 5 years, Chipotle has traded at anywhere from 15 times PE ratio to 30 times PE ratio. And it tends to trade in this range. And then we look globally and we look at other successful restaurant chains. We may look at Starbucks, and so we look at our peers, and they, over the cycles, they're trading at about 20 times PE ratio. And then you can compare the growth of Chipotle or the profitability of Chipotle versus the others. And all of this helps you put a price on what the value is. So let's say we think that 20 times is what they've traded at in the past. It's maybe a premium to competitors, but we think it's deserved because Chipotle is growing faster. So we think 20 times PE ratio is the right number. What we would do is we would put 1.3 and multiply that by 20 times PE ratio, which would equate to our target price that we think the stock will trade at 3 years from now. And then if that turns out to be 20 times 1.3, which is 26, and then let's say we look at the current stock price and it's trading at 13, then we would say, okay, we think the stock is going to double in the next 3 years because we think 20 times PE ratio is right, and we think 1.3 times is the right earnings per share. So that's one way to look at it, and that's a relative valuation analysis. And that works with PE ratio, but it also works with other ratios. You could use price to book ratio, compare that to historical patterns and peers in the industry, and then find the right price to book ratio, or EV to EBITDA. These are all different ratios that you could use. You could even use free cash flow yield. What is it traded at in the past? What do I think it will trade at in the future? The second way that we can come to an intrinsic value of a company is through the discounted cash flows analysis. And here I would guide you to our DCF template found on YIS.org and found in your My YIS portal. And what we've created for you is a Google Docs where you can go through and make various assumptions. The advantage of a discounted cash flow analysis is that you can forecast many more years into the future. So relative valuation analysis was maybe for 3 years into the future and put a multiple on it, or 5 years into the future, put a multiple on it. Discounted cash flows, you're going to forecast cash flows 20 years into the future and then discount all of those cash flows back at a cost of capital or a required rate of return. And so it's a little complicated. Don't worry. This is college level material. But basically, if you have $10 today, $10 tomorrow, $10 every year for the future, $10 100 years from now is worth less than $10 next year. And so that's the discount rate that you're discounting it back. But get started on a DCF model. You can go to the Google Docs. It'll walk you through it on the steps, and you can put in your growth estimations, you can put in your profit margin estimations, and you can put on your cost of capital, your rate of return estimations. And then this will give you an estimate of what the value will be. The terminal value, you'll see a phrase called the terminal value. This is the value, let's say you forecast cash flows 20 years into the future. The terminal value will then be an estimate of how much that will grow for the next infinity years. And so that terminal value growth rate may be 3%, 5%. It won't be as high as 10 or 20%. And so I hope that explains two of the ways that we calculate a target price or an intrinsic value of our company, which is going to give us our upside or our opportunity as an investor of how much money we think we can make by investing in this stock.